All right, let's dig into something really interesting today. We're looking at the chemical giant OCI. Now, these guys are a huge deal in their market, a real powerhouse. But their latest earnings report just dropped, and honestly, on the surface, it makes absolutely no sense.
And that brings us to the big question for today. It's a genuine puzzle. You've got a company that absolutely dominates its field, and then bam, they post a huge deficit. So you have to wonder, right? Is this a company on the brink of collapse? Or is there something much, much smarter going on behind the scenes?
And this is the number right at the center of it all, a net loss of 67.6 billion Korean won for 2025. For a company the size of OCI, a number like this doesn't just happen. It feels intentional. It's a signal. And our job today is to figure out exactly what that signal means.
So here's our game plan. First, we'll unpack the paradox of this chemical giant. Then we'll get into the real story behind that big loss. After that, we'll see what kind of high-tech future they're trying to build. And finally, we'll size up what the road ahead looks like for them.
Okay, first up, the paradox itself. To really feel why that loss is so shocking, you first need to understand just how much of a titan OCI really is in its industry.
So, where's the money coming from? Well, OCI's business is built on some serious industrial muscle. You can see their revenue is almost entirely driven by just two core areas, carbon chemicals making up a huge 63% and basic chemicals at 36%. This is their bread and butter.
And they're not just in these markets, they own them. Get this, they've got the #1 market share for high-purity phosphoric acid and the biggest production capacity for carbon black in all of South Korea. They're a top 3 global player for pitch. And here's the real kicker. They're the country's only producer of what's called 11-9 polysilicon. That's silicon that's 99.999999999% pure. You need that stuff for the most advanced semiconductors. So again, how on earth does a company this powerful end up losing money?
Which brings us to part 2. Let's finally unravel the story behind the loss. We're going to break down that 67.6 billion won number and see what's really inside.
And here it is, the most important clue right up front. This loss did not come from their actual business operations. Sales didn't just tank, their factories didn't grind to a halt. Nope. The real answer is buried deep in the accounting.
This table tells you almost everything you need to know. Look at the top line. Revenue is strong, 1.54 trillion won. But the real giveaway is that third line. Operating cash flow was a positive 86.2 billion won. What that means is the company's day-to-day business was humming along, making plenty of actual cash. So, if cash was coming in the door, where did this giant on-paper loss come from?
Well, here's the first piece of the puzzle. A massive, one-time accounting move called an impairment charge, worth 58.2 billion won. Think of it like this. The company bought some new assets, like factories and machines, and then later decided, you know what, on paper, these things aren't worth what we thought. So they officially wrote down the value. And the key thing here is, this is a non-cash charge. No actual money left the building.
And they weren't done. Here's the second piece, another impairment, this time for 44.9 billion won on intangible assets. So you add those two big paper write-downs together, and boom, they more than cover the entire net loss. This wasn't a business failure, it was a carefully planned financial maneuver.
And believe it or not, this strategy actually has a name. It's called a financial big bath. It's like ripping off a Band-Aid. Management decides to take all the possible bad news and book it all at once to clean up the company's books. Yeah, it makes the current year's profits look terrible, but it totally wipes the slate clean, setting them up for much cleaner, healthier-looking profits down the road.
Okay, so that's the what. But the really big question is, why? Why take this big bath right now? And that leads us straight into part 3. OCI is building a brand new high-tech future, and to do it, they first needed to clear the decks.
And just look at the speed they're moving at. It's pretty incredible. In what is basically a year and a half, OCI has been acquiring, integrating, and streamlining, all leading up to the launch of commercial production for silane. That's a super important material for next-generation electric vehicle batteries. This is not a company that's slowing down. This is a company hitting the accelerator on a total reinvention.
So the strategy is crystal clear, right? They're moving away from their old-school commodity products, the kind that can have their prices swing all over the place. And instead, they're going all in on these high-value, high-tech sectors, like materials for semiconductors and advanced batteries.
And this isn't just chasing hype. They are positioning themselves perfectly to capitalize on some major global trends. The AI explosion needs their ultra-pure polysilicon. Recent export controls on graphite from China suddenly make OCI's battery alternatives way more valuable. And their plan to use the byproducts from one manufacturing process to feed another? That's just brilliant. It gives them a huge cost advantage.
All right, for our final section, let's look at the road ahead. We've seen the strategy. We've seen the pain they took. So, was it worth it? Let's see what the data tells us.
Now, this DuPont analysis is a great way to look under the financial hood. Sure, the profit margin and the return on equity are negative, but we know why now, right? That's just the echo of that big bath. The number to really look at here is the equity multiplier. It's a measure of debt, and at 2.04, it's totally stable and manageable. The company's core financial structure is solid. That negative ROE isn't a sign of collapse, it's just the temporary pain of this massive transition.
And this SWOT analysis really brings it all together. Their strengths are obvious. They're market leaders. Their weaknesses? Well, being dependent on commodity prices is exactly the problem this new high-tech strategy is designed to solve. And the opportunities in AI and EV batteries are just enormous. They could easily dwarf the threats if OCI plays its cards right.
And if you need one final piece of proof, here it is. The Altman Z-score, which is a classic model for predicting bankruptcy risk, still puts OCI firmly in the safe zone. Add to that a solid A+ credit rating, and it's clear the financial world sees right through this one-time loss and knows the company is fundamentally healthy.
So, our verdict couldn't be clearer. OCI's loss in 2025 wasn't a setback, it was a strategic reset. They took a calculated hit to clean house, clear out the risk, and floor it into a high-tech future. All the signs are now pointing to a major earnings rebound starting in 2026.
And that leaves us with one final thought to chew on. In a world that's changing this fast, maybe the bravest, smartest thing an old-school industrial giant can do is intentionally take a big, painful hit today, all to guarantee it's still leading the pack tomorrow. The analysis that formed the backbone of this explainer comes from a report by HDIN Research. If you're looking for these kinds of deep, strategic insights, you can reach out to them at the email you see on the screen. Thanks for joining me.